Welcome back, everybody, to Volatility Trading Strategies. So if you're not tuning into my live streams, what are you doing with your life? There's not that many places you can go to get your volatility trading questions answered, so definitely hang out on our lives and ask me anything. But one of the most common questions we get has to do with adding leverage. There's just a lot of people out there who like to ramp things up and chase those big gains. In this video, I'm going to show you exactly why I do use a little bit of the 2x leveraged ETFs, but why I never use the 3x leveraged ETFs. And this is a lesson that's going to apply to all investors out there, not just trading stocks. It also applies to the difference between trading the VXX, the UVXY, or the UVIX, the difference between trading riskier short-term options versus the safer long-term options. This applies to all investing. You really do need to see the analysis on this one. It can save you a world of pain in the future. And of course, if you are interested in my defensive rotation strategy that I'm going to show you today, or our multiple volatility strategies that do trade the SVXY, the UVXY, Iron Condors, you can claim your free trial to VTS in the description down below and check out all of it for free before committing. So one of our core strategies here at VTS that makes up 20% of the total portfolio solution is called the Defensive Rotation Strategy. There's a full video for it, so I'm not going to get into it here, but really quickly, we use volatility metrics to determine the most stable times to be holding the Nasdaq index. And then when volatility is rising, we move to safety and hold a utilities ETF called XLU, which performs much better than stocks during dangerous periods. And finally, when the market is all out crashing, we move to full safety and go 100% cash. And this right here is what the Defensive Rotation strategy looks like without using any leverage. For equities, this is just using the single 1x Nasdaq ETF called QQQ. None of our safety positions ever use leverage, so it's just how much risk we want to take with our Nasdaq positions. And you can see it's very good. Annual return of 23.87% and a maximum drawdown of just 27.35%. Anytime you can get an annual return that's 20% and a maximum drawdown that's pretty close to that level as well, you know you're dealing with something with exceptional risk management. Emotionally, it's very easy to follow the strategy. Remember, in comparison, the S&P 500 returns less than 10%, but it has maximum drawdowns of over 50%. So getting that risk-reward ratio much closer to each other is really good. And another thing to note here, which is central to my entire point today, notice how the strategy has already recovered all of the 2022 drawdown, and it's actually 8% above that previous all-time high right now. In comparison, this is the QQQ itself, just buy and hold. The QQQ had a nearly 38% drawdown and it's still down over 6%. But because we're tactical and we actively reduce drawdowns, this is a much higher rate of return with much lower drawdowns, far easier to follow. So when people see how stable our return has been, the natural question is, well, how come we don't just add a bunch of leverage? Now I'm going to show you what happens when you use 2x leverage, and then after that, 3x leverage. In orange, we have the defensive rotation strategy using the 2x Nasdaq ETF called QLD. And I do want to note here, this is our official strategy. We do use the 2x QLD. This is the one you'll see in the daily emails. Now, I do note below that if you do have lower risk tolerance, you can just replace it with the 1x QQQ. But I personally feel 2x will match most people's risk tolerance. Now the annual return jumps up to 31.53% a year. But there's always that unavoidable risk-reward trade-off, and the maximum drawdown increased to 43.17%. That happened last year. Now, just a quick side note, that's not because our risk management failed or anything. We did move to safety positions. But as we saw in 2022, it was a strange year where the safety positions, bonds, utilities, real estate, gold, they all tanked just as much as the stock market did. There were very few places to hide. We couldn't have seen that ahead of time. It hasn't happened in decades, but that's the whole point today. You're never going to know when that future terrible market environment that will affect your strategies is going to come around until it actually happens. That means you better not be over leveraged, and you have to have your risk management in place ahead of time. I personally feel like our official strategy using the 2x QLD is the ideal balance here. Definitely an uncomfortable drawdown, but a long-term rate of return that can easily sustain that. As of the end of July, our official strategy using 2x leverage is only 1% away from all-time highs. But buy and hold on the 2x QLD is still miles away. It had a maximum drawdown of 65% last year, and it's still down 27%. It needs a 37% rate of return from today going forward just to get back to break even. That's the basic math equation that makes drawdowns such a long-term drag on performance. Remember, losses are always more costly to a fund than gains are beneficial. If you suffer a 20% drawdown, you need 25% after that just to get back to break even. If you suffer 50%, you need a full 100% to get back to break even. The lower you go on this list, the more exponentially disastrous it gets, right? What if you lose 80%? Now you might be thinking, oh, that's crazy, but check this out. This is buy and hold on the triple leveraged TQQQ. As you can see, it did suffer an 82% drawdown last year, meaning it was 455% away from breaking even. And despite how good it's done in 2023, it's still over 100% away from getting back to break even. This really could take a while. Now moving on to everybody's real curiosity today. Of course, nobody can buy and hold, but what about using it tactically? In red there, that's what our defensive rotation strategy would look like if we also used the 3 times TQQQ. Now, obviously our risk management is far superior to buy and hold. We wouldn't be 100% away. It's currently less than half that. But I think you can see why we try to find that risk-reward balance. Using no leverage, the black line, pretty much everybody can easily sustain a 27% strategy drawdown. For something that returns over 20% a year, that's a lower drawdown than anything else you'll find. But if ramping it up to 3 times leverage, the red line, even though that 45% annual return would be very tempting, in reality, a 67% drawdown would breach the risk tolerance of many investors. Now, you might be one of the few out there that actually could stay the course. I don't know. That's up for you to decide. But I can tell you, for me, that does breach my risk tolerance, and I never use 3 times leveraged ETFs for any of my trading. Like I said, the future is always unknown, and we're never going to know when that future terrible event is going to happen. This is why officially we use that 2 times QLD. Enough to get a nice boost in performance, but not enough to be really worried about what happens if we get caught out in the storm. Now, I would also strongly encourage people to not buy and hold anything. I know asset managers love to tell people that's the best strategy, but that's only because they want to collect those easy fees and focus on marketing rather than actual investing. As we know, buy and hold leads to terrible results and excruciating drawdowns that take a long time to recover from. At VTS, because we have good risk management in place and we do rotate into safety when necessary, it does mean we can take on some additional risk and we can use the 2 times QLD. We're not going to ride stocks off the cliff during a market crash. We exit to utilities or cash before the major damage is done. Now, I can never tell you directly what you should or shouldn't do with your own money, but if you want my opinion, I don't think any investors should use the 3 times leveraged ETFs. The potential bump in performance that you're going to get is just not worth the massive drawdowns that it's going to cause. This also, by the way, extends to the volatility complex. I don't think anybody should be using the 1.5 times UVXY or the 2 times UVIX until they've mastered that 1 times VXX. I also don't think people should be using those risky short-term options until they've demonstrated through a crisis that they can manage risk with longer dated contracts. Leverage is always a double-edged sword. In good times, you might talk yourself into it, and look, for a little while, it might actually work. But that bad market is coming at some point. Maybe not for several months, maybe not for a few years. But at some point, you're going to realize why using excessive leverage is a bad idea. Always remember, losses compound much faster than the gains do. I don't want you to have to meet that reality face to face in the future. That's why I make these videos. Stay safe, everyone. Long-term investing is actually pretty hard. Thanks for watching. So for an extensive volatility metrics dashboard updated daily, and to see all of the live trades for our tactical rotation and option strategies, click this link right here and claim your free trial to the VTS community. You're always welcome to join us anytime. See you next time.